Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, John Logan.
Hi, guys. Welcome back to the show, and what a day we're going to have. Ooh. And this is culminating after the two and a half big days we had last week starting Wednesday, and it's all about the Shanghai, guys. So we're going to pull up our Shanghai chart, and we're going to take a look at this, and this is our weekly view. This is the index itself. Almost had a 10% pullback. Basically, a lot of things shut down there. 35.54, we closed below. That was a big deal last week. We always talk about weekly closes below inflection points or above inflection points, balanced areas, if you will. That happened, and that means that it was okay to be short, not okay to be long, but at the very least, you weren't going into the weekend throwing the dice. That's kind of the way we look at this particular index. It's got some issues, fundamentally speaking. Technically has now got a big challenge ahead of itself. And, where does this thing end up heading? And this is, again, affecting everything on the board. So we're just going to kind of try to figure out where next support is on the Shanghai. And around 2750, 2800, somewhere in there is where I see the next support level on this. And can we go back and get back above 3554? Absolutely. Would the world love to see that? But, now we're in a situation where will the world love to see it based on some kind of new government throwing the sink at it intervention or not? I mean, that remains to be seen, because that obviously would be a little bit of a not a Band-Aid, but a cast, if you will, on the situation. We got to look. I was up all night. I don't know if you can see that. We're going to try to get Joey Zhang on the phone at the break. I was on with him about things going on in Asia most of the night. And I want to get him on because some of the things that, he has insight into over there in the Hong Kong and the Chinese markets are pretty invaluable. He's actually, in the middle of quite a bit of activity right now over there. So I wanted you guys to hear firsthand experience, somebody in Asia, what's going on. So we're going to try to get him with Tommy, our new tech person, can get him on the other Skype line, hopefully at the end of this break. So crossing my fingers there. We got to take a look at the S&Ps. Again, we look at this thing as the barometer, if you will. Here's our scanner, and we look at the situation of the S&Ps in particular. I'm going to kind of go into my S&P grid here. And we always talk about when we get around these inflection points, especially the major ones, what is the tone or the tide of the market, as Basil says. And it's just a great way to coin this. As of the close on Friday, this was where we kind of stopped and, took a snapshot. Right now this morning, I don't think a lot of stocks are open yet, and the indications are going to start coming in, and then we're going to have some adjustments here. But as you look across this, there's no mystery to anybody. A sea of red on the S&P 500 on every time frame. And, coupled with some of the Fed statements, the Chinese thing, they're not going to, as we've been talking about, the chance that the U.S. rate structure is going to edge higher, in my mind, we've been talking about this, is just non-existent. Nobody's going to do it. You got to look around, and I think they've now figured out that the globe's got some problems. It's had some problems. It's been ignored for a while. And the market that's been relatively over-optimistic about, being Teflon coated about anything, the Greece, the world, the Puerto Ricos of the world, the Chinese slowdown of the world over the past year or two, is now going to have to be arbitraged back to reality, right? Now the market can overreact, and the market can just start saying, you know what, we've been through this before. The guy's going to get the cheerleader at the end of the movie, and I'm not going to be that worried. But an arbitrage situation back to reality could be in the 1700s on the S&Ps. That would take us back a while and kind of recorrect for the optimism that may have gotten built in, or the euphoria, I guess I would say at this point. So as we look at our breadth, getting back to what I was going to talk about here, as we look at our breadth, when we got around these levels on the S&Ps, namely and I'm going to go back in time so we can see this, the 2060s and the breadth that started crossing over here on our long term, that was where we were looking at. We got to close below. We looked at 2085.50 as the first sign, and we said, we were up in the 2100, whatever. We got to get back down below 2085.50. We've got to look at the breadth. We got to get below 2060. We got to look at the breadth. And, that's why it's extremely important to get confirmations and conviction around some of these inflection points and have some kind of barometer, some kind of fence to lean on via profiles on the index itself and a summation of the internals to let you know if the internals are in concert with what's going on with the index itself. Now, we had a bunch of leaders, without question, that had kind of been towing the load for a while, namely the Apples, the Netflixes of the world. Some earnings, disturbing news on a couple of different levels. What are we doing this? Okay, pre-markets, Apple's 98.70. I think the S&P futures are down. What are they down? 70 right now? Is that right? Oh my God. Ooh. Ouch. All right. So, Apple, I did a Bloomberg brief on this. You guys, I think we talked about that, but when we started breaking the 124.70 and churning around below it, that was technical damage Apple had received for the first time in a long time. And there's that first time in a long time back in 2013, 2012, we started turning on this stock, but we haven't had any technical damage till now. But what do you do here? Let's go back to the S&Ps. And we always talk about, let's look at the long-term trend. And if there's any green shoots that trend may be changing, we might want to be able to kind of step in and start getting our toe wet on the other side, or we can continue to sell resistance in this case. All right. Now, as we look at this is our daily. We just looked at our weekly. Here's our 240. And as you can see, there is nothing to hang on to down here. There are no new profiles attempting to appear. And if I go back into my scanner and I go to the futures section, as you can see, red across the board, here's the real-time price of this thing around 1900, the level of the market, and we do not have any indications to buy this yet. And I was looking at this last night, and I was like, you know what, man, wow. I think we were trading like 1915, something like that. We've actually caved in another 20 points this morning, equivalent of approximately 200 Dow points. Here's the 60-minute on the ultra short term. You see how this acts? We get the orange bar, we get the new profile appear, and we have new inflection points to pay attention to. And that, little rally in the last 4 hours. This is extreme volatility, guys. And, as a trader, intraday trader, you got to trade lighter right now. And you've got to pay attention to where to pick your battle. You can't just kind of jump into the hurricane, so to speak, and see what happens. Here's that 1937.88, 1938, and we've come down, and now we're below profiles again. So the big numbers that you can only pay attention to for day trading are 1916, 1937. There's a lot of folks that are going to be coming in this morning and looking at, that are going to be looking at what's going on and calling portfolio managers, trying to figure out what's going on. And they're, of course, going to say dollar cost average. I don't know what they're going to say, but there's going to possibly be some follow through in the opening here. So be ready for that until we kind of shake some people out. Remember, a lot of people, this wasn't, on the news. It didn't seem like there was a panic in place. The VIX was not really showing that. And I'm going to pull up the VIX really quick here. And let me change this to the right month. I'm stupid. Let me get that rolled over. And let me see if we're on the right thing here. Okay. So, in my opinion, and here's the VIX on a long term on the weekly, and this is on the September contract. We obviously broke strike, closed above last week. Obviously breakouts on the upside here. This is not extreme VIX yet. but now it's starting to show some fear in the marketplace. Obviously, Basil's probably going to talk about this a lot, and I'm very interested to hear what he's got to say. But the fact of the matter is, going back to simplicity's sake, I'm going to take a look at my profiles, and if I'm going to do any nibbling here, I'm going to wait for some green shoots to start happening, and that means some gray cells appearing also. But I'm also going to kind of look at the dollar. I'm going to look at the notes. We're going to look around as a relative sense. We're going to try to cover that ground before the opening here. And I'm going to tell you, possibly how to put this puzzle together, things to be aware of, in addition to some of the flat-out individual instances on some of these products that we're looking at. Okay, guys, we'll be right back.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. John takes your phone calls. Now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, guys. Welcome back to the show. And you're in for a treat. We've got Joseph Jong on from Hong Kong. Joey, are you there?
I'm here. How are
Awesome,
you guys?
man. It's good to talk to you again after 3 hours of not talking here with you. we had to stay up all night talking, folks. There's just bedlam all over the place. So these are the days and nights you don't sleep. And Joey is at the wheel and in the middle of a lot of high-end trading situations, and it's a full-time job right now, right, Joey?
It's been an exciting few weeks here, actually.
Wow.
I think it was first, I think on your scanners, especially the sentiment indicators, the dashboard,
Right.
all showed negative weeklies, dailies, 240s and 60s as of last Thursday and Friday.
For everything.
For everything, basically.
Yeah. Joey, I didn't introduce you properly. Joey is in Hong Kong, and he's been graduated from UCLA. He's been there for, what have you been there continuously for?
17 years.
17 years, yeah. So he's a very good friend of mine, and I talked to him quite a bit about what's going on all over the globe. But Joey, continue. You were saying something about the heat map that you were a big part of, actually.
Exactly. The heat map basically alerted us to basically sell everything as of last middle to end of last week, and basically it's the risk off trade. So there's only really four things that you should be long. The euro, the dollar, the yen, and gold.
Okay, let's talk about that, because what
treasuries.
Right. What
and U.S. treasuries. So five things.
Right. You're a very large trader. You manage quite a bit of money in your lifetime.
Yeah.
How do you put this puzzle together today? You mentioned some products right then, but on a kind of relative, how do they all work together? We got about 3 minutes before our next break, but I want to talk about this a little bit deeper than 3 minutes.
Yeah. So
how do you put these things together to try to make sense of this? And you just said some things that we should be long and short right then. So
right. So basically, you want to be long of those four things, and you want to be short everything else against it, because if you look at the S&P, we've gone below the 12-month moving average, which is just above 2020 or around 2020-ish is where the 12-month moving average is. Over the last how many years? Let's see. Over the last, I'd say since 2000, really, every time it's gone below there. In 2000, when it went below there, it was a 50% correction. In 2007, when it went below there, or early 2008, when it went below there, it was a 58% correction. And I'm talking about a monthly close below that level. So we're pretty close to the end of the month. It's the 24th. It really looks like it's going to close below that. And the two times recently that it closed below that was back in 2010 and 2011 during the European crisis, the two times during the European crisis. And this time, I guess you can call it the Chinese crisis. But even those two times, it was 17 and 22%. So let's just give it the benefit of the doubt and say that this is going to be a pretty quiet one. It's not going to be the big kahuna. If that's the case, then we're still talking about at least a 20% correction from the top, which will take us to right around 1650 to 1680 level. So
Okay.
we're still at 2 big figures in the wrong handle, meaning we're still trading we're actually at 1906 right now, and I'm looking at least a correction down to a 1650 to 1680 on the S&P futures. And
Gotcha.
that can happen pretty quickly, as we're seeing right now.
Right.
The problem is, the longer the top takes to make, and this is probably the longest top that we've seen, the more dramatic the sell-off is, and that's where we are right now.
Hey, Joey, I hear the music. Can you please hang around? I want to get into some other
Okay,
things.
sure.
Okay, cool. We'll be right back, guys.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you, like it does me, call 1-855-750-4051 to find out what they can do for you. That's 1-855-750-4051. Call them today. Everbank is a member FDIC and equal housing lender.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com. Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com
ThinkOrSwim under Trading Newsletters.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, guys. Welcome back to the show. We've got Joseph Jung on from Hong Kong. Joey, you still there?
Yeah, still here.
Great, man.
So,
Great.
we were just talking about the S&P, and target is at least around 1650 to 1680, and the Nasdaq target being around 3350 to 3400 is the bare minimum. And the reason I say this is because even in the last two downturns in 2010 and 2011 with the European crisis, the Fed was in an easing state. They were ready to pull the trigger on another QE. I don't think we get a QE4. I don't think they're preparing for it. And even if they actually come up with it, and QE4 happens, it would be a dramatic turnaround from the tightening stance that's happening today. So, which means it'll take a lot longer for the Fed to turn around from a tightening to a QE4. Whereas the previous two times when the correction stopped at 17 and 22%, they were already in the mode of another QE. I get it. But the road there is going to be very, very choppy, because I'm actually looking at buying out of the money calls on the Hang Seng and the HSCI 8-share index in Hong Kong just for 2 weeks. 2 week out of the money calls.
We talked about that last night. Why is that the case? Explain the fundamentals behind that one.
Well, the HSCI index is down 10% as we speak. That index future is down 10% right now. Today
Alone.
Today only.
Okay.
And this is also, if you look at the support line, right around 9,000, 8,800 to 9,000 is the support line. Right now it's trading at 9,200. And the HSI is also trading down near support. Now, this support will eventually probably give way, but before the end of the month, I do expect the Chinese government to come in with some real big measures, some big intervention. They've been kind of holding back a little bit, but they have plenty in the arsenal. The one thing that people kind of tend to overstate is the Chinese devaluation. Now, the Chinese has devalued 5% so far, or 5 or 6% so far. The target devaluation is probably 10%. Now, this is versus all of Europe, which is 25 to 30%, Latin America, which is close to 50%. So, the Chinese economy has been going down while the American economy has been going up, and the Chinese has pegged their currency with the very, very strong U.S. dollar. So it makes perfect sense for the Chinese to devalue the currency between 5 and 10% is perfectly normal. Right. So, but the problem with that is it's caused, for the last 10 years, people have been piling money into China and just parking the money there because, the currency has gone stronger. Mm-hmm. And the government has had a strong currency policy. Now, because they're trying to go into a freely traded currency, the government is trying to take their, foot off the gas a little bit at a time. And part of doing that is letting the currency find its natural trading range, and I think the natural trading range is somewhere around 660 to 680 level. Today it's at 651, so we're gonna get a few more percent. But the government, there's been a lot of talks in the market that the government is going to come in before month end with some kind of, maybe not a bazooka, but a pretty big rifle to help this thing. And so that's what we're looking at right now. I think what you'll see is a massive gyration, volatility in the market. You'll see a big spike in the market, and that may not be long lived, but that may be enough to kill a lot of the shorts, and that's all that it's really just temporary stuff.
Yeah, I hear you. I tell you what. That being said, let's figure out how what you just said might affect some other things around the globe that we need to kind of cover really quick here before you get off the air, because your time is valuable.
Yeah. So the things that I've been looking at is the two markets that's been very sticky on the upside has been the Nikkei and the Nifty in India.
Okay.
The Nifty index in India, Nifty 50s, has been very strong, and the Nikkei has been extremely strong until today. And today's the break, and I would continue to sell these two markets because everybody's been on the yen carry trade where they're short, they're long dollar yen or short the yen, and they're long the index or all the stocks.
Right.
And today is the first major reversal. I mean, we've had a little bit of weakness last week and stuff, but nothing has broken down until today. So with that breakdown, you're going to see a lot of money coming out of that carry trade, and that's going to continue.
Right. So I've been a big fan of buying the yen on dips, or the devaluation of the yen on dips. And Custer's last stance on this, 123.68. I've got it on the screen right now, guys. This was kind of my uncle point. We actually closed below there on Thursday. So that was kind of sit tight. Let's wait for some new profiles to appear. But Joey, one of the things we were talking about last night is, the euro, and seemingly is that this, so-called safety situation now relative to, maybe rates not getting lowered in the States, and the carry trade situation you just spoke of. I mean, I'm just, let's talk about that.
The euro is a, it's all about positioning, and right now there's so much dollar longs that just as a matter of positioning, you're getting a squeeze, and that squeeze right now it's at 115.33, and 114.70 roughly was around where your top of the range was. So this is broken above the range. Let's see if it closes the week here. If it closes today here and the week here, then basically the new range is between 115 and 125. And
that's true.
I don't agree with that range.
I don't either. There's a huge hole in the marketplace, and this could move super fast and volatile in that area you just spoke of. Yeah, go ahead.
Because that's the gap. It literally gapped from 125 straight down, and so we're gonna fill that gap. If it closes above this 115 level for the week, then we're going to look to fill that gap. Now, it may not get all the way up to 125, and this is really purely a technical type of move. Fundamentally, I still think the euro goes lower, but at the moment, I'm not arguing with fundamentals right now. I'm just covering my short and going long a bit of euro because there's just too many positions against that right now.
Right.
And I think fundamentally, if you think about it, if China is slowing down and the U.S. delays their rate hike, then it's even worse for Europe and for Australia and for everybody else.
Yes.
fundamentally, it doesn't make any sense that the dollar should weaken here just because the Fed is putting off rate hikes. Well, if Fed puts off rate hikes by 3 months, then the ECB won't be hiking rates for another year. So,
Yeah.
it's
It's like a
really,
little anomaly in the short term, but the long term overhanging mess is still right. Yeah.
the long-term overhanging mess is that once we get through this squeeze, I can't wait for the day that it shows new profiles where we can short this thing again.
Right.
But when we short this thing again, I think this thing goes back to parity, or beyond. But
Yeah.
I really don't see it holding up near 120 or 125. That's not a natural level because the Fed is going to
ridiculous.
continue. Yeah, I mean,
And it's only going to hurt them. It's only going to hurt them. So they're going to have a vested interest in that not happening also,
Yeah, I mean, I don't think the Fed is going to be raising rates a lot. So that's, and I think this is going to be a very, very slow raise compared to every other raise. So that I agree with. But at the same time, the rest of the world is even more screwed up. So
yeah,
it's all relative. And right now, I think Aussie dollar goes to 60 because if China is screwed and all the commodities have broken down, the Aussie dollar has been very sticky because the euro has been going stronger. So the Aussie dollar had some people exit that short position. So last week it was very, very sticky to the upside, and I've just started kind of re-shorting the Aussie dollar.
That's amazing. A lot of people look at this as if it's on sale. And, we literally, folks, have just broken down below a new level, 72.75 on the Aussie dollar. And what Joey's saying basically is they are more susceptible than anybody to the problems of China as a supplier, if you will. And fundamentally speaking, that's an issue. And technically speaking, from a technically challenged standpoint, we're actually having new breakdown situations right now on the charts, and there's things on their lows go lower, things on their highs go higher, and until we get
the Aussie yen looks particularly vulnerable. I mean, it's broken down, and that thing will move faster than the Aussie dollar because the yen is going to strengthen at the same time. The yen, it has the highest correlation to risk-off trades globally. So if there is a risk off, the yen strengthens. It always happens. It is the highest correlated trade there, and since everybody's been on the other side of that trade, then I expect the yen to continue to be well bid. So especially against the Aussie dollar.
Well, we got about 2.5 minutes. Let's hit some other things here. I want to get your opinion on this quickly. U.S. Treasuries, short-term, long-term. What are you thinking here?
U.S. Treasuries, there's nothing else to buy other than Treasuries. So,
right.
I think longer term you're pretty safe as well because I really don't see the Fed being very aggressive. And if we get a blip
and these
down,
problems aren't going to disappear tomorrow. You know what I mean?
I think in December we get a rate hike. And if we get a rate hike in December and Treasuries pull back, it's probably a good chance to buy them again.
You honestly think there's still a chance to have a rate hike? I mean, I know there's a mathematical chance, but what is your gut
December?
feeling?
Yes, in December,
really?
Yes. Not in September.
It seems to me they're looking for any reason in the world. Now they've got another one to just say screw.
Well, I mean, the last I checked, the Federal Reserve's job was not to bail out the rich shareholders of America.
Of the stock market, yeah. No. I understand theoretically what their job is, but we all know what the deal is. You know what I mean?
Yeah.
Okay.
But
so
I think they will still raise, but 25 bips, and then they're gonna pause for a long time. So it's really irrelevant. it goes from 0 to 25 bips. I mean, it's really irrelevant, and I think the treasuries are the only place to be in this time of turmoil. I would really be careful about high yield in China, high yield in America, high yield anywhere is in danger, just because once we're in risk off mode, the high yield will go as well. And I think in China the high yield has really blown out already, and it's a lot of people have gotten hurt from that.
Real quickly, you got 10 seconds before you got to leave. I know you got to go. Well, I hear the music. Joey, it's been a pleasure. Thank you for coming on today.
Take care. Thank you very much.
Pick you up later. Okay, man. Be right back.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Hi, I'm Steve Rhodes, host of the Trader's Edge heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Catch Larry Pesavento, a 40-year veteran trader. He uses pattern recognition, Gartleys, butterflies, ABCs, and Fibonacci in order to trade these markets. Trade what you see. Next on TFNN.
My goodness, these S&Ps are below 1900 again. Thanks, Joey, for coming on. That was very insightful. I mean, it's trying to cram everything into a couple of 15-minute segments is difficult. Joey has a lot to say, and I actually rely on his comments highly to look at some of the things I'm looking at in the U.S. because he's got such a barometer on what's going on over there and globally. But let's take a look at a couple of things we haven't really hit yet, some levels. Here's the big levels on the treasuries here. We got about 5 minutes left, guys, so I'm going to hit this pretty hard. The 10-year, we have reached the weekly unfair highs around 129.14.5. We talked about those were the targets. Ultimately, they've been hit. Need to kind of wait and see here now. Just sit tight. Again, not the short that needs to be put on gold. I'm a little impressed how gold hasn't really gone above this 1160 general area that we talked about last week. There's 1168, it's just seems like the freak factor would be on this a little bit more. Here's something else that we've been talking about. Now the demand issues are coming in. Let's take a look at November beans. This has just been a whitewashing here on the downside. We're getting into that 850 area that I've talked about earlier, and I didn't think it was going to happen this quickly, but, there's really nothing down here. So, again, I would let the 240s kind of regulate this trade down, and when we start breaking above profiles on this, you'll see it in the scanner. That's the deal on that one. Crude oil, I kind of like how this is acting. I'm still looking at getting long above 41.75 on crude oil. That's the way I'm looking at it. Dollar getting weaker is kind of helping that situation out, obviously. Let's go back into the S&Ps. Let's take a look at some levels here, if you will. And, again, nothing in the way. This is our 240, the regulation of the trade down. Here's our 60. All these are in the scanner. Remember, you can go in here and get this. Type in your futures section. In particular, get the futures indices. There's the red across the board on the S&Ps. And there's the level of the market around 1900. Let's get back. This is our 60-minute levels. Things to be aware of: 1916, 1937, 38 up top. That's the drill on that one. Sorry about that. Something got hit. Here we go. And we've got about a minute and a half left. We're going to take a look at the euro one more time. This is the situation on the euro. Here's our weekly unfair highs. Joey was talking about this, 114.68. We get any daily closes or especially a weekly close up there, we could be in the ether for a while. And why is that the case? There's a big hole in the marketplace here. Next level is around 125, like he said. And we're going to have to take a look at the 240s. There's really nothing going on here. Nothing's backing off on the euro. And that's a little disturbing for anybody who's trying to short against that 114.68. I did last night. Uncle on that one, and I think you guys need to sit tight on that one. If we get back down below there, then it's time to short. But right now, Joey said, 125 can happen on this, whether it makes sense or not. And again, is it a short-term move against the long-term situation on that particular product? Without question. Let's take a look at the Japanese yen to drill down into this a little bit deeper. Long term, again, below 122.36, that's, very damaging. We've started that process. You cannot be long this right now. The yen dollar, there's the first breakdown. We talked about support picking about 123.68. This has been a very favorite trade of mine. Now the worm has turned. It started happening last week, and we've got to step back, pay attention to things like that. Guys, you've been great. Larry's next. Stay tuned. Watch out today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This is TFNN.